the tech industry moved fast and broke its most prestigious bank. On the last night of its existence, Silicon Valley Bank was hosting VC Bill Reichert of Pegasus Tech Ventures, who was giving a presentation on how to pitch your wow to investors, to about 45 or 50 people. Mike McAvoy, the CEO of OmniLayers, recounted the scene for me. "It was eerie over there," he said. He saw a number of people exiting the building during the event, looking subdued. What is Silicon Valley Bank? Founded in 1983 after a poker game, Silicon Valley Bank was an important engine for the tech industry's success and the 16th largest bank in the US before its collapse. More than 2,500 VC firms banked there, and so did a lot of tech execs. What happens to Silicon Valley Bank's customers? Most banks are insured by the Federal Deposit Insurance Corporation, a government agency that's been around since the Great Depression. So of course, the accounts at Silicon Valley Bank were insured by the Federal Deposit Insurance Corporation, but only up to $250,000. That's how Federal Deposit Insurance Corporation deposit insurance works. That might be a lot of money for an individual, but we're talking about companies here. Many have burn rates of millions of dollars a month. How bad could it get? Even small disruptions to cash flow can have drastic effects on individuals, companies, and industries. So while one very likely outcome is that the uninsured depositors will eventually be made whole, the problem is that right now they have no access to that money. There are lots of people who are wondering if their next paycheck will be disrupted. This is especially rough for startups. A third of Y Combinator companies won't be able to make payroll in the next 30 days, according to YC CEO Gary Tan. An unexpected mass furlough or layoff is a nightmare for most companies. After all, you can't make sales if the sales force isn't coming into the office. Some investors are loaning their companies money to make payroll. Penske Media, the largest investor and the parent company, Vox Media, told the New York Times that it was ready if the company required additional capital, for instance. That's good, because Vox Media has a substantial concentration of cash at Silicon Valley Bank. Of course, one other problem is that a lot of investors were also banking at SVB. Thank you for watching. If you like this video so far, please hit like and subscribe to our channel. We truly appreciate it. Now back to SVB collapse. Does this have something to do with crypto? SVB's failure didn't have anything directly to do with the ongoing crypto meltdown, but it could potentially worsen that crisis. Crypto firm Circle operates a stable coin, USDC, that's backed with cash reserves, $3.3 billion of which are stuck at Silicon Valley Bank. So if SVB doesn't exist anymore, what takes its place? In response to the collapse, the Federal Deposit Insurance Corporation created a new entity, the Deposit Insurance National Bank of Santa Clara, for all insured deposits for Silicon Valley Bank. It opened for business on March 13th. People who have uninsured deposits will be paid an advanced dividend and get a little certificate, but that isn't a guarantee people will get all their money back. How did we get here? So this is actually bigger than startups and Silicon Valley VCs. To understand how this happened, we've got to talk about interest rates. Since 2008, they've been pretty low, sparking a venture capital boom and some real silliness. See, WeWork, Theranos, Juicero. There's been a lot of froth for a long time, and it got worse during the pandemic, when the money printer went brr. So did Silicon Valley just flunk the prisoner's dilemma? Okay, this mismatch in risk in and of itself won't tip a bank over. A good old-fashioned bank run did that. And at Silicon Valley Bank, there was no George Bailey to stop it. Here's how it happened. When interest rates rose, VCs stopped flinging money around. Startups started drawing down more of their money to pay for their expenses, and SVB had to come up with cash to make that happen. That meant the bank needed to get liquidity, so it sold $21 billion of securities, resulting in an after-tax loss of $1.8 billion. It also came up with a plan to sell $2.2 billion in shares to help shore itself up. Moody's downgraded the bank's credit rating. Customers tried to withdraw a quarter of the bank's total deposits on a single day. Now, recall, another bank called Silvergate had just collapsed, for crypto reasons. Investors, like horses, are easily spooked. So when Silicon Valley Bank made this announcement on March 8, people bolted. Peter Thiel's Founders Fund advised its portfolio companies to pull out, ultimately yanking millions. Who was in charge here? Until shortly after the failure of Silicon Valley Bank, its, now former, CEO Greg Becker was a director of the Federal Reserve Bank of San Francisco. That's one of the 12 banks overseen by the Washington Fed. While the bank run was ongoing, Becker told VCs, "I would ask everyone to stay calm and to support us just like we supported you during the challenging times. As anyone who has ever been in a long-term relationship knows, telling someone else to calm down is a way to ensure they lose their entire goddamn mind." What does this mean for Startupland? The venture capital ecosystem exists because once upon a time, banks wouldn't loan startups money. Think about it. A 23-year-old nerd slapping together a startup in someone's garage or whatever usually doesn't own anything they can put up as collateral against a loan. One way that Silicon Valley Bank bolstered startups was by offering risky forms of financing. For instance, the bank lent against money owed to a business account's receivables. Even riskier, the company lent against expected revenue for future services. Silicon Valley Bank also offered venture debt, which uses a VC investment as a way of underwriting a loan. And it worked. These kinds of products helped build Silicon Valley into the powerhouse it is now, says Jonathan Hershen, who's done high-tech PR for the last 30 years. The bank also would get slices of companies as part of its credit terms. That meant it made $13.9 million on Fitbit's IPO, for instance. More recently, Coinbase's IPO paperwork revealed that Silicon Valley Bank had the right to buy more than 400,000 shares for about $1 a share. Coinbase's shares closed at a price of $328.28 the first day it was listed. Startups aren't the only ones who need to raise money. Venture capitalists do too, often from family offices or governments. Silicon Valley Bank invested in a number of VCs over the years, including Excel Partners, Kleiner Perkins, Sequoia Capital, and Greylock. This kind of gets us to one of SVB's key problems. Silicon Valley is actually a small town. And while that meant SVB was the cool banker for the tech and life sciences startups here, that also meant its portfolio wasn't very diverse. The incestuous nature of Silicon Valley startups means gossip is a contact sport, because everyone here is hopelessly entwined with everyone else. Thank you for watching. If you like this video, please hit like and subscribe to our channel. We truly appreciate it.